If you're running a business doing $3 million a year or more, there's a decent chance your current legal structure would not survive a serious lawsuit, a divorce, or a personal judgment. You probably have an LLC, maybe a few of them, and you've been told the charging order protection is enough. But deep down, you know that a single member LLC in the wrong state with your name all over it is not a fortress. Because once you're in real wealth territory, a simple LLC is often just a speed bump. One aggressive creditor, one bad event, the operating business, the intellectual property, the equipment, and the cash flow can all be at risk. In this video, I'm going to show you how domestic asset protection trusts, irrevocable trust-owned LLC interests, and hybrid structures actually work, and when they're worth the cost and control trade-off. So you can build real protection around your most exposed assets without turning your business into an accounting nightmare. I'm John Conrad, forensic accountant and founder at Numeratus.us. We're the white glove concierge accounting firm for ambitious startups, entrepreneurs, and high net worth clients. We cut through the complexity, eliminate compliance roadblocks, and help you safely navigate business and wealth protection in the 21st century. Let's get into it. Let's be honest about what an LLC does. A limited liability company separates your business assets from your personal assets. In theory, if the business gets sued, your personal home and brokerage accounts are generally protected, but the reverse is not always true. If you get sued personally, your LLC membership interest can be attacked. In some states, a creditor can get a charging order that intercepts distributions. In others, depending on the structure, a creditor might be able to force a sale of the LLC interest or even seize control of it. Single-member LLCs are especially vulnerable. Several states have weaker protections for single-member LLCs because there are no other members whose rights need to be protected. If you're the only member, a determined creditor has more options. Then there's the issue of what the LLC owns. If your operating business, your intellectual property, your equipment, and your cash are all sitting in one entity, a single judgment against that entity can wipe out everything at once. Most 3 million plus businesses are still one lawsuit or one divorce away from serious damage. Not because the owners are careless, but because the structure was built for a smaller version of the business and never upgraded. So the first thing to accept is that once you cross into real wealth territory, a basic LLC is usually the starting point, not the finish line. And the businesses that survive serious events are the ones that layered protection underneath the LLC. A domestic asset protection trust is an irrevocable trust set up in one of a handful of states that have strong creditor protection statutes. The idea is that you can be a beneficiary of the trust and still get meaningful protection from future creditors. Not every state allows these type of trusts. The strongest jurisdictions include Nevada, South Dakota, Delaware, Alaska, and Tennessee. Each has different rules about the statute of limitations, exceptions for pre-existing creditors, and who can serve as trustee. The key feature of a domestic asset protection trust, or DAPT, is that you give up direct control over your assets. You can't just write checks from the trust whenever you want. There has to be an independent trustee making distribution decisions based on the trust standards, usually something like health, education, maintenance, and support. That loss of control is a trade-off. You are intentionally making it harder for a creditor to argue that the assets are available to you. If you retain too much control, a court can treat the trust as your alter ego and ignore it completely. DAPTs are not magic. They don't protect against existing creditors in many cases, and they don't help with child support or fraudulent transfers. For someone with significant business or investment assets and no immediate creditor threat, they can be a powerful layer. The second takeaway is that a DAPT gives you protection by design, only if you accept the control trade-off and set it up before a creditor is already knocking on your door. If you're realizing that your business structure is one layer deep, that's good news. It means that you have room to improve. At Numeratus.us, we help clients map out what assets are most exposed, what entities should own them, and how the tax reporting stays clean after the structure changes. If you want a structure audit, the link is in the description below. One of the most practical hybrid strategies is to keep the operating LLC in one place, but have an irrevocable trust own the membership interest. This combines the liability protection of the LLC with the creditor protection of the trust. Here's how it works. You form an irrevocable trust, maybe a DAPT, maybe a different type depending on your goals. The trust contributes capital or purchases the membership interest in your operating LLC. The LLC still runs the business day to day, but the economic value of the LLC is now inside the trust. If you get sued personally, the creditor can easily reach the LLC interest because it's owned by the trust, not by you. If the LLC gets sued, the assets inside the LLC are at risk, but the trust-owned interest may be harder for a creditor to seize or force distributions from. This structure also creates a separation between business cash flow and personal cash flow. Distributions from the LLC go to the trust, and the trustee decides how and when to distribute to beneficiaries. That separation is exactly what makes the protection credible. The downside? Complexity. You now have two entities to maintain, two sets of books, 2 tax returns in many cases, and a trustee who has real discretion. If the bookkeeping is sloppy or the trust is treated like a personal piggy bank, the protection collapses. So the third point is that putting your LLC interest inside an irrevocable trust can create a much stronger wall than the LLC alone, but the structure only holds up if the accounting, governance, and distributions are handled correctly. Now we have to talk about taxes, because the type of trust you use changes who pays the tax and what happens to your assets when you die. Most irrevocable trusts used for asset protection are intentionally structured as grantor trusts. That means you, the grantor, still pay the income tax on the trust income. That might sound bad, but it's a feature. It lets the trust assets grow without being reduced by taxes. It keeps the trust integrated with your personal tax return. Non-grantor trust, on the other hand, pays its own taxes. That can be useful in some income shifting strategies, especially if the trust beneficiaries are in lower tax brackets. It also means a separate tax return, separate accounting, and potentially compressed tax brackets that hit high rates very quickly. For estate tax purposes, assets in an irrevocable trust are generally not included in your taxable estate. If you have a business worth $10 million, $20 million or more, moving growth assets into an irrevocable trust early can remove future appreciation from your estate. But this is where the control trade-off really matters. If you retain too much control, the IRS can pull the assets back into your estate. If you retain the right to change beneficiaries, remove trustees, or direct investments in certain ways, you may accidentally destroy the estate tax benefit you were trying to create. The fourth takeaway is that grantor versus non-grantor status and estate tax inclusion are not side issues. They are central design choices that have to be made before the trust is drafted, not after. Most people don't need to go all in on an irrevocable trust structure. What they need is a hybrid approach that matches the right tool to the right asset based on risk and control needs. Think of your assets on a spectrum. On one end are lower risk core assets where you want maximum control. Maybe your primary operating company, your personal residence, or your day-to-day cash. They often stay in revocable or directly owned structures. On the other hand are high-risk exposed assets, intellectual property that could be sued over, equipment that could cause injury, real estate with tenants, or minority interests in volatile partnerships. These are the assets that benefit most from irrevocable or trust-owned structures. The hybrid strategy uses a revocable trust or holding company as the primary vehicle and then carves out the most exposed assets into irrevocable slices. Each slice is designed for a specific risk, with its own trustee, its own tax treatment, and its own distribution standard. This approach costs more upfront. You're paying for multiple entities, multiple trust documents, and ongoing compliance. But the alternative is often a single point of failure, where one lawsuit or one judgment takes down everything you've built. So the final point is that real asset protection is usually a hybrid. Revocable where control matters, irrevocable where exposure is highest, and never a one-size-fits-all template. If you're running a successful business and you're starting to wonder whether your structure can survive a serious event, that instinct is correct. The time to fix it is before the event happens. At Numeratus.us, we help entrepreneurs build and maintain the holding entities, trust-owned structures, and tax reporting systems that make asset protection real. Book a call through the link in the description at Numeratus.us if you want to learn more about privacy. Thanks for watching.